Walmart rips again in Q4, but as inflation retreats, so does customer spending per trip. This article just rubbed me the wrong way. When I looked at the article and when I started to analyze what the author was saying, one, the headline just gave me chills because there was such mixed messages in all of what was being offered, not just in the headline, but then when we get down into the article is implying that for some reason the article isn't implying that there's going to be a decrease or that there is this decrease in inflation. And while inflation is down, to say that inflation has retreated, I think is a mischaracterization of what is actually going on in the economy. And it's saying that shoppers are spending, which to me, they're spending less, but they're spending less because inflation is down. And that's an assumption that I don't think we can actually make. They may be spending less because they're having troubles financially. They may be spending less because they're not able to go into the store and to have their money go as far as it used to go. And by saying inflation is down, it almost implies that inflation is back to its target rate. When you get down into the article, it talks about Walmart on Tuesday reported another quarter of strong results as its low prices attracted shoppers looking for deals. I don't know what Walmart she's gone into. I don't know what Walmart that this particular a writer is frequenting. But when I go to every store, prices are consistently climbing higher and higher. And to say that they're going to Walmart or flocking to Walmart because of the deals, I have not seen many deals. I see that inflation is still above what it should be. And she does go on to say, and to give her credit, she does go on to say that there are bouts of inflation. But then she comes back to say, yet inflation is fading. So it's this mixed message on what is going on with inflation that has readers, have consumers, have the general public just trying to figure out where are we? Are things getting better or are things staying the same? While inflation is down, which it is down, but the way they present this, I don't know if they're talking about inflation overall or they're talking about inflation in certain sectors, but then they follow up with food costs remain high. So if inflation is down and food costs remain high, it leads me to wonder what exact numbers are they using, and they're not giving us a starting point. Yes, inflation may be down from the 5% that it was running, but where is it at now? Is it above the norm or is it below the norm? And when we look at all the data, it's clear to me that inflation is still soaring. No, it is not at the rates that it was before, but it is still much too high. This notion of prompting increased need for free food resources, and I think that that's key. That there should be a need for free food and resources for those who can't survive and those who can't help themselves. But also, I think there's a need to accurately inform people on what is actually down, what is actually up, and really to report the data about the economy in a more comprehensive and a more clear fashion so that we don't get these competing messages. When we turn to those who work in Wall Street, to those who work in the Federal Reserve, they're very clear that inflation may have come down from its highs, but that inflation is higher than we've seen it in many, many, many years, and that it's well over what the target should be. Wall Street is bracing for more strong U.S. economic and inflation data next week, meaning that when that data comes out, it is highly unlikely that the Federal Reserve is going to move swiftly to cutting interest rates. Let's look at what the Federal Reserve says. If you like this program, please come on and give us follow us, give us a like, make a comment in the comment section so that we can continue the discussion. Federal Reserve minutes. Officials worried that progress on inflation could stall in coming months, meaning that inflation is down from its all-time highs not too long ago. And I shouldn't say all-time highs, but recent highs not too long ago, but that inflation is still high, and that the fact that people are saying that there's going to be a reduction in interest rates quickly in 2024, mid 2024, that may not be the case because the data is not really supporting that. Let's look at this information about inflation. Let's take a look at it. Only a couple. This is a report about the Federal Reserve, the chairman of the banks of the Federal Reserve, and this is what their inclination or what their responses were at their last open meeting. Only a couple were worried about the opposite risk, that the Fed might keep rates too high for too long and cause the economy to significantly weaken or even slip into a recession. They're saying it clearly. The Federal Reserve, they're saying it clearly that they are in a position, looking at the data, that interest rates will have to remain high. If you're hoping that interest rates will come down just swiftly and that the economy will roar away, it's not likely, because from the data that they're seeing, from what's going on around the economy, they're clear that things are too high to bring interest rates down, and that inflation is still high, meaning that individuals are still struggling with higher prices across the board. There are some elements of the economy where inflation has really come down, but there are other elements of the economy where prices are still much too high and continuing to escalate, to the point where the Federal Reserve is going to have to maintain high interest rates well into a significant part of 2024 if you read into what they're saying. When we look at CPI, here's the issue. Here's the problem. The problem when journalists, the problem when others talk about CPI is they're not clear as to what the data is that they're talking about. What is this data point comprised of? The Bureau of Labor and Statistics, the Bureau of Labor Statistics reports lots of CPIs. There are tons of them, and they have to do with each of the different items that individuals may purchase. There's a CPI for shelter, for food, for transportation. They report tons of these numbers, and then they compile these CPIs into different groupings. And here's where the problem comes with a lot of the mainstream media, and what comes with a lot of those who are trying to sell products, as well as who are trying to let us think that things are rosy when they are not, is that they constantly shift which CPI they're talking about, and they constantly refer to one and give the data point for another. Let's go to the Bureau of Labor Statistics and see what they say about what the CPI, what are the different types of CPI that are widely used and reported, and what the purpose of each one is. We already know that food and beverages, housing, apparel, transportation, medical care, recreation, education, and communication, and other goods and services are a part of the CPI. But listen to this carefully. Additionally, for analytical purposes, the CPI is also divided into food, remember that, energy, and all items less food and energy. The CPI for all items less food and energy gets considerable attention as a measure of underlying core inflation, which is not subject to the volatile movements of food and energy prices. So what they're saying is the one that is most widely used by the public and that gets considerable attention is the core CPI, and it excludes food and energy. But the problem is when that one doesn't look good, they revert to other measures and other statistics, also called CPI, but they're compiled with food or energy included. And this gives a skewed impression as they shift back and forth based on what their political leanings or what their agenda is, in an attempt to give either a bad picture of the economy or to give a good picture of the economy unnecessarily. We see from the data that this is also from the U.S. Bureau of Labor Statistics, that the thing that is down is energy. Commodities are down a little bit. Commodities, less food and energy, is down a little bit. But energy is the sector that is down. Everything else is up. So when you say that Walmart has these great prices, that may be the case, but it has nothing to do with this reduction in inflation, because we see from the charts that food inflation is very high. Food away from home is even higher, but food in the stores is still high and running greater than what it should be based upon the Fed's target rate of 2% for inflation. So the reporting on this subject sometimes gets confusing, sometimes gets consumers confused. They're going to the store wondering why they can't make it, why they can't cope. They look at the news articles, they hear the media saying that on one side they're saying inflation is down, on another side they're saying food prices are up. But the problem is everybody's using different numbers and they don't know how to make heads or tails of it. Look what the Bureau of Labor Statistics says. The BLS publishes thousands of CPI indexes each month, thousands, including the headline. The headline number, or what's called headline CPI, is all items CPI for all urban consumers, and the CPI for all items less food and energy. So you've got two CPIs that they frequently use, the headline and what's called the core CPI. Let's continue. The latter series, widely referred to as the core CPI, is closely watched by many economic analysts and policymakers under the belief that food and energy prices are volatile and are subject to price shocks that cannot be damped through monetary policy. However, all consumer goods and services, included food and energy, are represented in the headline CPI. And here is the problem. They don't know oftentimes when they're reporting, when they're doing their writing. Some of them know, some of them don't. Some of them are doing it nefariously. Others are just doing it out of just not being clear on what they're reporting on or what they're hearing. Whether it's the core CPI, which excludes food and energy, or whether it's the top line CPI, which includes food and energy. They hear a number, they get a read on that number, and then they report it as if everything is down across the board or if everything is up across the board. When in actuality, some categories may be down and other categories may be up, and the thing that is they're reporting on may be best without food and energy in it, because food and energy is just volatile. Every day the energy markets could do something else. And if you're trying to get a consistent read as to what way the inflation numbers are going, you don't want a number that shifts rapidly over the course of 24 hours. So you want to exclude food and you want to exclude energy. And when you do that, you get a totally separate picture. Here, I've got the chart from Labor and Statistics, Bureau of Labor Statistics. The top line, 3.1, that's what you've been hearing. Everybody's saying, oh, inflation's great. Top line, 3.1. They never tell you that that's the top line, the headline CPI. They don't tell you that that includes two elements that really shouldn't be in our calculations as to how inflation is going. But also you see that food is at 2.6. which is still higher than the 2% target. Here you see energy is negative 4.6. So clearly what's impacting the inflation numbers is simply energy. But everything else is up. And that's what consumers are feeling. That's what home buyers are feeling. That's what people who are looking for cars are feeling. That's what people who are buying services and all types of goods, people who are just moving throughout, or buying apparel, buying things, and just operating in the economy. They're seeing that things are high. Everything, everywhere they turn is high. Transportation services, my goodness, transportation services is up 9.5%. So when they say inflation is cooling, they're using the headline, and no, they're not wrong, but you can't use the headline number without realizing that the headline number is being affected by just one particular area of the CPI. So when we really get into it, let's look at how Bureau of Labor Statistics, this is how it should be done. Over the year ended January 2024, the consumer price index for all urban consumers increased 3.1%, which is still above the Fed's target rate of 2%, which is alarming to have it that high, but at least they're clear on how they're reporting it, how they're talking about it. They're talking about it so that they can be clear that that's everything. But then they automatically come back and say food prices rose 2.6%, while energy prices decreased 4.6%. Prices for all items less food and energy increased 3.9%. This is how you report CPI data. This is how you deal with it, because by dealing with it this way, it enables people to realize that inflation is still running just under 4%. And yes, compared with increases of 5.6% in the year end of January 2023 and 6% for the year ended January 2022, those were extraordinary years. And so it's good to say that inflation is not running as hot as it was, but inflation running double what the Fed target is, I don't know if that's room to celebrate. And certainly the Federal Reserve chairman, they don't think the same thing either. The Fed chairmen are clear that these numbers are alarming. 3.9% inflation is alarming. That means that your investments are going to be impacted, your housing, your food, everything is going to be impacted. Your rent payment, your auto loans, your cars, everything's going to be impacted. And also, if you're in the market to purchase something and you need a loan, that's going to be significantly impacted. And there's not really, if you can wait it out till inflation comes down and interest rates come down, that's one thing. But a lot of consumers can't wait those purchases out. Your car breaks down. Now you got to find a transportation. You got to go out and buy a car. And when you go out there to get it, now you're getting struggling to try to pay with high interest rates and to pay high prices on the vehicle. So it's a double whammy. It's not only the interest rates are high, but the price of the vehicle is high as well. So you're getting hit on both sides. And if you check out our video on the economy and you check out some of our other content that's talking about inflation and talking about the debt crisis that is in America that is going on right now, the average credit card debt is above $6,000 per credit card holder. When you look at that, when you look at housing debt, we're in a debt crisis in America where Americans are carrying large debt and are struggling to stay ahead. And the delinquency payments are just soaring. Delinquencies for housing, delinquency for cars, delinquencies for loans and on bills and utilities. The American consumer is struggling. And yes, interest rates have come down or inflation has come down, but that doesn't mean that it's still not a terrible problem and that these interest rates are creating an even bigger problem with those who are carrying debt loads. The American economy does have some significant headwinds, but there are winners and losers. The winners are lenders, the banks. Rising interest rates benefit those who lend money, like banks and bondholders. Exporters, when domestic prices rise, exported goods become cheaper in comparison. Companies with pricing power, businesses able to raise prices in line with inflation or even slightly ahead can maintain or even grow their profit margins. And that's what we saw during the pandemic. That's what we saw in 2022, 23, 20, all of those, both of those years, we saw prices not just accounting for inflation, but going up even higher and profit margins soaring. So food prices and prices in the grocery store oftentimes are disconnected from the inflation data because companies see an opportunity and they take it to soar the prices and to make profits where profits would not be made otherwise. Real estate investors, in some scenarios, real estate values can rise alongside inflation, potentially benefiting owners and investors. So if you own property, when inflation hits, you're doing well. But if you don't own property, if you're not in the housing market, if you're not in the real estate market, as those prices increase, you're not doing as well. Also, any asset classes where those asset classes are driven up by price increases. Individuals who own stocks and who own other assets, when inflation hits, they grow in their net worth. And this is one of the reasons that certain sectors and certain ethnic groups and groups within society typically don't do well under inflation because they don't own houses and they're not heavily invested in the stock market or in other asset classes whose value is driven up by inflation. And as such, they find themselves consistently at a wealth gap because others who own are automatically just, passively growing in wealth while they are staying stagnant. Let's talk about some of the losers as it relates to inflation. And there are losers, fixed income earners. And I like to think all of us are fixed income earners, but the literature differentiates between the different types of earners. This is mainly those who are retirees and others relying on pension, savings account, or fixed rate investments see their purchasing power erode as inflation outpaces their income. Borrowers, rising interest rates makes loans and mortgages more expensive. Unless you're going to go out and buy a house in cash, most of us are going to take a loan. And if you're entering the housing market right now, if you're entering a time when you're trying to purchase a big ticket item like a car or some other big ticket item, you're going to suffer because the interest rates are much higher than they have been. Low wage earners, those with limited means, struggle to keep up with rising cost of essentials like food and housing. Those who are close to the poverty line, when inflation comes, their paychecks often don't immediately adjust, and as a result, they're already just barely keeping their head above water. And when inflation hits, the bank account gets squeezed on all sizes. Rents go up, food goes up, insurance goes up, transportation goes up. Every time they have to buy something, that goes up. Interest rates on their credit card goes up. And so we're seeing a squeeze as a result of inflation being almost double, 3.9%. The Fed target rate is 2. That's almost double what it should be. And so while it's not 5 and 6, it's still, still in crisis territory. We're still in, this is difficult time for those who are at the poverty line or just above the poverty line. They're significant losers during this period of time. Those who don't own housing or real estate, there's no upside going on for them. It's just all downside. When you own assets that are carried up in value, there's a little plus negative thing going on where you're losing in the grocery store, but your home value is going up. But if you don't own a home and you're just renting and you don't own stocks or bonds or anything that's going to be carried up in price as a result of inflation, not necessarily bonds, but stocks and houses, you're just losing. There's no upside for you with inflation coming on as strong as it is. Cash intensive businesses, companies with slim profit margins and limited ability to raise prices can struggle to survive in an inflationary environment. And I would argue that in this environment, the Fed really wants to lower interest rates because we've got lots of businesses, not only small and large, who took real estate loans, took loans out during the time when the interest rates were very low. And those loans are coming due. And when they come due, they'll have to refinance at these much higher rates. And for those who had slim margins before, for those who were existing on just barely getting by, they were profitable, but not much, but they could continue to go year over year, just kind of humming along and just kind of bumping along the road. When they have to refinance and now their mortgages are going to soar, that eliminates their profit margin and in some instances makes them not profitable. So they're going to have to lay off. They're going to have to restructure it. If that won't get it, a lot of those businesses will fold. And we're already have seen some instances of businesses when it came time to refinance just folded up shop because there was no longer a justification for their existence. The inflation